There's a lot of uncertainties in the market right now. Ray Dalio addressed some of these uncertainties and explained how the market will look like and what are things that should be taken care of to have a safe future. He said that there are different kinds of inflation. We are not particularly worried about the classic supply demand pressing up against supply, although we'll find out soon because there's something like 10% of GDP stored in financial assets that are going to be coming out. So it's likely that there's going to be a big backup in demand, and that will probably raise prices significantly. And it also depends on how you account for inflation. Because like housing prices themselves are going up a lot, but rental prices are going down a lot. The big things, if you went to a 3% inflation rate or some bounce, that's not one of those things that get us very nervous or very excited. The real issue is that we have a supply demand issue of bonds because we are going to have to sell a lot of bonds to those in the world who own bond inventories and they have very low interest rates or negative real interest rates. They are overweighted in US bonds and they are gonna have to buy a lot more. And that is also coming at a time when Chinese capital markets, other capital markets are becoming more attractive. That creates a supply demand issue that can create monetary inflation because there will not be enough demand to buy those bonds. That means that it's likely that the Federal Reserve will not be able to taper or cut back and might actually have to increase to prevent interest rates from going up, and that's a classic monetary inflation. So that's a bigger concern than just the spur. For most of the world, the real question is what are interest rates relative to inflation? And also, what is happening with all this liquidity? Because there's a huge amount of liquidity and negative real interest rates. That means that it pays no to own any debt instruments. That pays not to own cash. Certainly not cash, where you got no interest rate in an environment of some amount of significant inflation. It will be, let's say, in the vicinity of over 3%. So you get taxed at that rate in terms of buying power. So you are going to see the continued inflation in other assets, and it pays to borrow a lot, like in to borrow houses right now. To buy interest, only loans being made when there's basically no interest rate. In other words, you don't have to break that pay back your principal anytime soon, and the interest rates are so low. So there's a lot of money being thrown around that way. Those are the concerning things because you build up a bubble. You saw the reaction in the markets when the Fed just even hinted at tightening. As per Ray Dalio, they cannot tighten a lot without having a big negative effect. So that's what it looks like. The whole picture of the low real interest rate, and then also the worries about the supply demand monetary inflation and also the Fed tightening. If you see break-even inflation rates go above 3% or something like that, and you see that spurt, then you have the dilemma of the tightening of the monetary policy. The other things are the whole shift in terms of the quantity of debt money that's being produced that goes into creating bubbles, creates an enormous amount of liquidity, and that will be manifest by either a rate price tracing inflation or a dollar decline. Then we also have to deal with the changes in the political situation, the wealth gap situation. The wealth gap is the left-right question. There's a lot of conflict in terms of left-right politics. There's a big move, pretty much probably to more left politics, believing that there's not enough fair share of incomes and so on. And those will create structural changes that will have effects. The amount of money which has gone to profits has increased from about 6% of revenue to about 14% of revenue, and that's decreased the share that's gone to incomes. Those things could be structural changes that shift wealth and income. We are here to those that are going to be more beneficial. That's particularly a US issue. It is a European issue too, although it's a world issue, but it differs around the world. Ray Dalio adds up that this is looking more like the late 60s and transitioning to the early 70s that has implications for the balance payments of the dollar. So we have covered what that inflation asset means for returns and bubbles that are developing because there's a massive amount of liquidity around and it's being thrown around, so that it's a different difficult environment for those returns to be justified. We are building kind of a bubble, so inflation in financial assets and so on is an issue related to liquidity anyway. What has happened is the net worth of Americans and most people in developed countries is higher than it's ever been. All of a sudden, it was a big boost to net income, but yet production is not. So what you have seen is a lot of people got a lot of money, which they are still holding, and they put it into the stock market, and everything and interest rate goes down. And they borrow, and that is a dynamic that creates a bubble. The mechanics when you have the liquidity and you drive down real estates and you drive asset prices up, that doesn't mean they come down. It just means liquidity drives those for their particular future returns. There's a ton of money around and the value of money goes down, and how much it goes down relative to goods and services and how much it goes down to financial assets. It's going to go down to both, and that really raises financial assets and it changes capital flows in important ways. It's easy to say that the Fed should tighten. They should put on the brakes a little bit. You'll see a very sensitive market and a very sensitive economy because the duration of assets has gone very long, and just the slightest touching on those brakes has the effect of hurting markets because of where they are priced and also passing through to the economy. Dalio suggests that we have to keep in mind since the cyclical peak in 1980 to 81, every cyclical peak in interest rates and every cyclical trough has gone steadily below the one before it until we have hit zero. Then every quantitative easing, in other words, purchasing of money and purchasing the bonds, has been greater than the one before it. That is a debasement of the value of the currency in one way or another. So the challenge of the Fed is going to be able to balance those in a highly political sensitive environment because of this wealth clash. So guys, here is the end of views of Ray Dalio. Please let me know your thoughts in the comment section below. And don't forget to like this video, share it in your financial community and subscribe to this beautiful channel if you want to receive more such amazing videos. I'll catch you in my next video. Till then, you can watch previous videos on our channel. Bye bye and take care.